Hello everyone and welcome to another options trading educational video from OptionsPath. Today we're going to give a quick introduction to a very common and popular options trading strategy called the debit spread. Now, debit spreads can be considered the opposite of credit spreads. If you want to learn more about credit spreads, we've done a past video that explains the credit spread in good detail. The link to the video is in the description area below. Okay, so back to the debit spread. This type of vertical spread is a strongly directional strategy in that you have a clear opinion on where you think the underlying market is going, either up or down. But often, when you have a clear opinion, you would just buy a call if your opinion is to the upside, or buy a put if your opinion is to the downside. So then why would you use a debit spread instead of just straight buying of a call or put? That's a good question. Now, the primary purpose of a debit spread is to reduce the risk on your trade. This simply means that you'd lower the premium you pay to take on a directional position when compared to just simply buying calls or puts. So how is this done? Well, each debit spread is made up of two options positions of the same type, underlying, and expiration. It would be a bought option and a sold option. Let's talk about the upside direction first. If you think that a stock, ETF, or index will go up in price, you would buy a debit call spread, otherwise known as a bull call spread. This is made up of a bought or long call where you pay premium and a sold or short call where you earn premium. The strike price of the long call is below the strike price of the short call. Because the long call is below the short call, you pay more in premium for the long call compared to what you receive in premium for the short call. This creates the debit on the trade, as opposed to the credit you would receive if you were trading a credit spread. But because you're offsetting the premium you're paying by selling a call as well as buying a call, the cost of the trade will be much less than the full premium you would pay if you were just buying a call. If the price of the underlying rises above the spread strike price by the expiration of the trade, you have the opportunity to earn profits on the trade. These profits would be less than if you just bought a call by itself, but again, the risk is also lowered because you originally paid less in premium for the trade. Now let's talk briefly about the other side, the downside or bearish debit spreads. If you think that a stock, ETF, or index will go down in price, you would buy a debit put spread, otherwise known as a bear put spread. This is made up of a bought or long put where you pay premium and a sold or short put where you earn premium. The strike price of the long put is above the strike price of the short put. Because the long put is above the short put, you pay more in premium for the long put compared to what you receive in premium for the short put. This creates the debit on the trade. But again, because you're offsetting the premium you're paying by selling a put as well as buying a put, the debit will be much less than the full premium you would pay if you were just buying a put. If the price of the underlying drops below the spread strike price by expiration of the trade, you have the opportunity to earn profits on the trade. Like the call side, these profits on a bear put spread would be less than if you just bought a put by itself, but the risk is also lowered because you originally paid less in premium for the trade. Okay, now that we have the basics established, let's take a look at some risk graphs for debit spreads and then a quick example. So this is the risk graph for the bull call spread. As we can see, this is a bullish position. We want the price of the underlying to rise above the long call and indeed above the short call in order to make maximum profit on this trade. If price does not go above the long call by the end of the trade, then we have the max loss, which is the net premium paid or the debit. And this is the risk graph for the bear put spread. As we can see, this is a bearish position. We want the price of the underlying to go below the long put strike price and below the short put strike price, in which case we'll make maximum profit. Now, if price stays above the long put strike price by the end of the trade or the expiration, then we have max loss, which is essentially just the debit or the net premium paid. So let's take a look at a quick example. As usual, I'm going to be using the thinkorswim trading platform for this example, but you could use any platform you wish. Now let's take a look at a chart. For this example, let's say that you think that the S&P 500 is going to rise within the next month. So you decide to buy a debit spread. In this case, a bull call spread. On the SPX chart, which is the S&P 500 chart, the current price is around 21.92, as we can see right here. You decide to structure the debit spread so that you're buying a call at 22.10 right here and selling a call at 22.15 right up here. Again, this sold call is simply to help offset your risk by making the premium you pay for the trade cheaper. So it's a 5-point spread on the debit spread, as we can see right here. And that's the maximum you can earn on the trade minus the premium you pay. Your risk, or the most you could lose, is just the net premium debit that you pay in the beginning of the trade. Now let's go to the order page to find out more. On my order page for SPX, I've chosen an expiration date around a month away, as we can see right over here. Now to put on the debit bull call spread, I would look on my call options chain for the strikes I'm looking for. In this case, the 22.10 for the long call and the 22.15 for the short call, as I just mentioned. So I'm going to scroll down here and look for the 22.10 and the 22.15 and look on the call side of the options chain. I have the 22.10 right here and the 22.15 right here, and I would just simply right click on the long strike, in this case 22.10, and go to buy, and then go to vertical, because this is a type of vertical spread. And then as you can see here, out pops my order ticket, and automatically it is a debit spread because I chose to buy, and we have my long strike price right here and my short strike price right here. And as you can see right here, the current net premium I would need to pay, or my net debit that includes the amount I pay for the long call minus the amount I pay for the short call, is around $2.30. So if my order gets filled at this price, that means that my maximum risk on this trade is the net debit I'm paying, which is $2.30. Now the question is, what's my maximum profit? As I mentioned, this is a 5-point debit spread, and you could tell by looking at the two different strike prices right here. There's a 5-point difference. So the maximum I could gain on this trade is $5. But since I'll be paying a premium debit to make the trade, I'll need to subtract that debit from the $5. That comes out to $2.70 for my maximum gain. So overall, my max risk on this debit spread is the net premium I pay at $2.30, while the max profit is the width of the spread minus the net premium, which comes out to $2.70. And if I wanted to put in this trade, I would simply click on confirm and send, and then wait for the order to be filled. And that's pretty much a simplified example of how to trade debit spreads. Hope you found it useful. We'll have plenty more instructional videos on trading options going forward. From all of us at OptionsPath, thank you so much and have a great day.